I want to get your take on some rates issues. I've got a bunch of charts here that I'm pretty excited about. And one of them is the negative rates, sort of getting paid to borrow. Now Japan joins Germany, Switzerland, and Denmark. It seems insane to me that I would pay someone to hold my money for me, but people are buying this debt.
Seems insane to me, too. And it's got to be a bad sign. There's no way you can think that it's positive. But it is a reflex in the system to try and get the economies to be better. The situation in Japan is very scary because they have the negative rates, they're doing QE, and the currency just popped
through the roof,
and the Nikkei's been sick. So these are reasons that the stock market's been queasy. But in the end, the question is going to be whether or not U.S. growth and China growth and Europe growth continue to move ahead. And my guess is that they will. And if they do, then this negative rate problem will dissipate. You also, as we talked about earlier, you have to get oil to stop going down because that's the beginning of the inflation and weak economies and
Well, do you feel like it has? I mean, you've got your finger on the pulse, right?
It's on the pulse, but it's in the unknowables. You know, I know that it's gone up $6 in the past week, and you're getting into the reflexive part. The S&P downgraded Saudi Arabia this morning. And when they do that, they put pressure on Saudi Arabia to think about cutting output. And they talk about output cuts in the past two or 3 days, and that's gotten oil up. But you still need to get the other factors to work in, like a drop in inventories or a drop in production or an increase in demand.
How did the central banks not see this coming? I mean, supply was through the roof, and they're just pumping out more and more, and demand just hasn't really been growing as fast. Do you think the Fed was behind the curve a little here?
I think there's just structural factors that are overwhelming. So on the demand side, every car that gets sold has much better gas mileage. And that goes on and on and on, from washing machines to windows. And then on the supply side, fracking has just been a juggernaut. And no one, a decade ago, had any idea that you could produce this much energy at that lower cost and that quick come on. So you got the supply and demand coming on, and here we are. And you've also had some problems in the Middle East in terms of their response function. They haven't been willing to cut production.
At all. I mean, it's crazy.
Maybe increase production.
In the past, they've cut production when you see drops like this. I want to turn to interest rates, though. I've got a really cool chart here on the Treasury curve. You can see, the yield curve, I should say, in Treasuries. You can see that it has flattened out a lot. How do you deal with this in your world when you need to use the yield curve as an indicator for what's going to happen in the future?
So I'm, more than most economists, I'm very market driven. And so I watch things like the yield curve, I watch the stock market. I'm not embarrassed to think that the stock market could be telling me something, or spreads we talked about earlier. And so there's no doubt that the yield curve, what we talked about, is indicating a slower economy, as has the stock market. But I also have to look at the fundamental indicators that I watch. And as I mentioned, I'm convinced that employment is solid and wages are accelerating. And so I think this is one of the times when the markets are getting more excited than the economy is. So I think this will pass, but I'm all over it. On the yield curve, it's definitely has flattened out, but it's not gone to a recession signal. And it got a lot flatter than this in like 94, 95, 96, 97, and you just had growth continued. So I'm on the edge of my chair, but I'm not willing to change my view yet because of the yield curve.
So what does this mean for your investing, or what would you advise people to do in this situation, where the financial markets basically point to a recession, but you don't actually think it's going to happen?
Yeah. So the first thing I bring to the table is I don't think we're going to have a recession. In the past, when you've had a recession, the market's gone down 30%. When you haven't had a recession, market corrections have been 15%. So it's been pretty binary. And I don't think we're going to have a recession. So I think the stock market is, in the making a low region more than another 15% down leg. I also think that owning assets, whether it's real estate or Ferraris or equities, is probably a better idea than owning cash.
I'd rather own Ferraris, I think, than any of those things. What do you think that central bankers or global finance ministers are going to do right now? There's a G20 meeting in a couple of weeks. You mentioned the yen shot up. The peso has just been a Led Zeppelin here. Yeah. Currency moves all over. People talking about the possibility of a new Plaza Accord, then that idea gets shot down. Will there be any kind of concerted action, you think, or do we need it?
So I think we need it. Whether we get it is a different thing. The OECD today called for a coordinated action, and they said, let's do more fiscal than monetary, which I think is the right cocktail. I doubt we're going to do it.
Wishful thinking, right?
Exactly. But, Matt, it looks to me as though policymakers are totally in action. You know, ECB, the Fed has pushed off rates, Bank of Japan is going nuts, and this morning, PBOC cut rates, and there's a fiscal action over there as well. So there's constant action in a reflexive sense. And now another policymaker in this, if you will, is OPEC. They're starting to make some action to support the price of oil. So I think we're in a pretty strong reflexive action. There are times when things are going to hell in a handbag, and policymakers are doing the wrong thing. They're tightening. And I don't think the Fed is tightening right now. They're going on pause until we see if this slowdown in the economy is passing or will pick up as you get into the spring and summer.